How to pass angel investor due diligence with your business. Imagine having an investor ready to back your startup but needing to clear a detailed checkup first. That's what due diligence is all about. It's a thorough review where angel investors look into your business before they decide to invest. They want to see if your company is worth their money and if you have what it takes to succeed. This process isn't just about your pitch, it's about the facts behind your business. Angel investors focus mainly on your founding team. They want to know if you and your co-founders have the skills and experience to make your idea work. They look at your past ventures, even failures, to see what you learned from them. If you've handled tough situations before, that's a big plus. They also want to see if your team can execute your plan. Next, they examine your market opportunity. They want to understand how big your target market is, what trends are happening, and who your competitors are. Be ready with real data, not just guesses. If you already have customers, pre-orders, or user engagement, show that off. It proves your product has demand and potential. Your product and how you plan to sell it are also key. Explain clearly what you're building, why it solves a real problem, and how you will reach your customers. If you have a prototype or minimum viable product, demonstrate it. If you're still developing, share your timeline and milestones. Prepare your financial documents carefully. Even if your revenues are small, show how you've spent money so far. Include your burn rate, which is how fast you're spending, and your runway, or how long your money will last. Make realistic projections for the next 1.5 to 2 years based on solid assumptions. Legal paperwork is just as important. Have your business formation documents ready, along with your ownership structure or cap table. If you have patents, trademarks, or proprietary technology, gather proof of those. If you've done market research, surveys, or have customer testimonials, organize these as well. Transparency is key during due diligence. When investors ask for information, respond quickly and honestly. If you don't have certain data yet, say so and give a timeline for when you will. Be open about any challenges or gaps in your team or product. Address potential risks head-on and explain how you plan to handle them. References matter too. Be ready to provide contacts who can vouch for your character and work ethic. Former colleagues, advisors, or customers can confirm your claims and give investors peace of mind. The due diligence process usually takes from 2 to 3 weeks, sometimes longer if your business is complex. Keep everything organized and designate one team member to handle investor requests. Use shared folders or online documents so everything is easy to find. Watch out for red flags. Make sure your pitch deck covers all the basics like your team, market, product, competition, and finances. Avoid overstating your progress or making claims you can't back up. If investors ask questions, answer honestly and thoughtfully. Dismissing concerns or being defensive can raise doubts. Help investors understand what must be true for your business to succeed. Talk about your main assumptions, risks, and how you plan to manage them. Showing you've thought through potential problems builds confidence. Throughout the process, demonstrate competence, honesty, and dedication. Keep investors updated on your progress, even during due diligence. Share new milestones or customer wins to show momentum. Respond promptly to emails and requests. Being organized and professional shows you run a serious business. Remember, investors want to fund good companies with strong teams. By preparing thoroughly, being transparent, and engaging sincerely, you can pass due diligence and move closer to securing their investment.